Congratulations on surviving the practice round. Now I'm going to go through the my West Texas School of Management. How do we do? Why do we do? And how are we gonna do better? This is an essential part of the BSG experience. If you don't do a good job of analyzing your results and making good decisions, then you're not going to do very well. Like I said in the practice round, nobody cares how anybody did. It's just preseason. If I make a negative comment about your company, first of all, we all know nobody took this seriously. And second, even if you did take it seriously and I make a negative comment, just don't take it to heart. We're all just learning here. So the first thing I do is I go to the footwear industry report, and I just work through it right from the beginning. So when I check in, I see how did I do, and I take an assess of the whole competition. What I see is two distinct tiers of competition: A, E, F, and B, with a pretty significant break between F and B, and then a lower tier of D, G, and C. To be honest with you, unless I'm D, G, and C, I don't pay any attention to them for the rest of the report, because if I'm A, E, F, and B, these guys don't matter. Um, the game to date is going to show what it is cumulatively. I'm going to give you a perspective, though, of how to keep track of all this performance stuff. So first page, I get a sense of how to go. Next page, more of how it went. I look at the earnings per share. Again, no surprise, A, E, F, B. Notice the place order matches the EPS. And frankly, the rest of these are all going to line up. Return on equity, stock price, they're all going to move very close in very close correlation with one another. Next is the credit rating. Again, this is not in the score, but remember, not in the formal score, but it certainly is important. I'm looking to see if anybody picked up a lot of debt or has really wrecked their credit rating. Nope. Image rating, even though A was first and E was second, you can see they didn't meet the standards in credit rating. The only team that did is B. I've not looked ahead, so I'm going to guess actually the reason that B met the image rating score is probably because they're running a good quality shoe. F is so close to the pack, I'm not sure why. Corporate social responsibility, like I said, this is the Goldilocks, not too high, not too low, just right. So a high of 5.3 million, that's okay. Maybe a little high. Average of 2 million, pretty good. Low of 0, probably not the right answer. Into the bonus points, this is where I start to pick up a lot of intel on what the other companies did. So I start to see what's their variance from their revenues. Where I see A and B and F that have a positive variance on their revenues, what that tells me is they probably won private label bids, but did not forecast them or did not add them into their financial results. More common is to see the misses. Now it's interesting because you can see the team E, the second place team, had a pretty big miss in their revenue, and you're going to see that also translates into a big miss in their revenue. Same thing for G, an even smaller miss in their revenue, but a big miss in their earnings per share. That's very common because as you lose those last few sales, it makes a dramatic difference in your earnings per share. You can notice that nobody got a bullseye award. Honestly, the easiest way to get a bullseye award is not the best way to get it, and that is just to not bid in the private label market so you don't have the issue of whether you check the boxes, and then be too pessimistic in your forecast because you'll sell all your shoes, you'll leave money on the table, which is not a good thing, but then you won't have a problem in terms of making less money because you'll always sell out. So usually winning the bullseye award is a good thing. But if you go ultra conservative, actually it's not. It's just showing that you're being ultra conservative. In future years, we'll have a leapfrog award. That's whoever had the most positive jump. Obviously, you only want to win that a maximum of once, or else it means that you can't get your forecast right and you're constantly going up and down. Now, as for Team E, why did they have such a big miss on their earnings per share? I suspect it might be because if you notice in here, the superior material usage was much higher than expected, and because of that, the prices were 27.4% high, which means that if you built your cameras and used a relatively high amount of superior materials, your shoes. Anytime I say cameras, just insert the word shoes. Your shoes with a high percentage of superior materials, your costs were higher than you were expecting, and that's another reason why your earnings per share were hit. So I get that key piece of information, look at the reject rates, okay, come down here. Actual demand was 10.1% higher than projected due to increased competitive intensity, okay? And by the way, if you all raise prices and throttle back, it'll actually lower the demand because people go, well, I thought I wanted to buy new shoes, but they're so expensive and so similar to the ones I've got, I don't want to. Here you'll see the comment about it looks like this kind of just a pablum comment that shows how things are supposed to grow. This is where it talks about supply and demand appear to be in balance. That's because y'all had very good market growth in year one. Um, and so year 2 or 3, it might be time to start considering some plant expansions. Over here I look, nobody order any plant plant expansions, and nobody put anything up for sale. On to the next page, very important page. And this is a key insight into how we did. So I always look at who was the revenue leader. Okay, F with 303. Well, that makes sense. They were in third place. You can see that A and E were almost exactly equal. G is the low at 234. That's not abysmal. That's, they're certainly in the fight. They can turn things around and make things better. I look at the marketing expenses, not much variation here, okay? Not going to be much variation here because this is round one. I look to see, did somebody have to pay a lot of interest? That would cue me to look down here to say they may have some debt, which may constrain them. That gets into the, when we look at awareness, motivation, capability, and competitive response. If somebody's got a lot of debt down the line, that's going to tie them down. Dividend payments, I can see A, C, and G forgot to add any dividends in. Nobody made any changes in stock with any stock buybacks or issuances. 3 teams ran out of cash, not good, but it's the practice round. These are all very good amounts of cash to end up with. The teens or the upper single digits or like 5 million and above, 5 to 20 million is a decent amount to have. Less than that, you were probably just lucky and didn't run out. More than that, and you're wasting that money when you could be doing something else with it as opposed to having it sitting idle. So I just take a scan across here, see what people are doing. These are some excellent comparative statistics, but you have to use them with caution. You would assume that you would always want to be the lowest in each of these. Well, except when it gets around to operating profit and net profit, obviously. Not necessarily. A lot of times a company that's running a very effective cost leadership strategy will have the highest cost of pairs sold in the industry. What? Highest? They're running thin margins and a lot of volume, and it's working for them. So you can't just be blind on this. Also remember that the net revenue's in the denominator. If somebody messes up and really loses a lot of market share, you're going to see they're going to have relatively high marketing expenses because they're spreading them over fewer and fewer cameras. That is a real kind of a death spiral when you lose market share and those sorts of things start to happen. Excuse me. Days in inventory. This is a pretty key insight here. So A looks good. The second place team, E, they finished with 92 days of inventory. That's going to hurt them next year. That's a significant amount of inventory. 69 is not great, but not a killer. 42, 16, these numbers are all in the perfectly normal range. This next page is also very important for understanding why you did. Because it knows I'm the administrator, it doesn't put any information out in this extra column. In fact, when you look at your products, it's going to have your information in this column, and you can just start to see, how do I stack up on all these costs? Labor cost, not much variation in North America, but quite a bit of variation in Asia Pacific. Certainly, you always want to be the low cost per shoe, and as I talked about, paying the lowest wage isn't often, frankly, the route there. Usually the teams that have the lowest cost per shoe are the ones that make sound investments in their workforce and their productivity. As you come down here and look at these numbers, one of the things you need to keep in mind is, what is the position of your shoe? If you are selling the best shoe in the industry, you can't expect to be down here at the lowest cost. By the same token, if you're selling the worst shoe of the industry, you better be down here at the lower cost. Actually, the one I use more than that is when I look at the total cost of pairs sold, because that includes the manufacturing, shipping, tariffs, and exchange rate adjustments. And so, again, you can't look at these numbers in isolation. You've got to know how your shoe compares to the rest of the market. Likewise, operating profit. I spend a lot of time looking here. How are people doing in general? $20, the $20 to $30 range is very typical in the internet. You can see Latin America in the branded segment was pretty low. Somebody even lost money per shoe. That's a tough one. Private label. These are fairly typical profits. You can see that they're actually above the branded. Often I'll see these even lower than this. We'll see how competitive the market comes over time. But spend a lot of time looking at this, because now you've transitioned from the how we did to the why we did. This gives you a great insight on your costs. On to the celebrities. This tells you who was signed, who was the second bid. Nice to know. And these are some nice little general trends. Where did we go? So it appears that we increased our prices a little bit, and we increased our quality quite a bit, and that trend continues across all 4 regions. So through the footwear industry report, I get my immediate results on how I did, and then as I get deeper into the product, you can see I understand why I did. Notice that I just don't look at my company. I look at the industry as a whole, because that's going to give me some tip-offs as to maybe what some teams are going to need to do in the next round, how aggressive they're going to need to be, so that I can factor that into my planning. Next up is the competitive intelligence report.